So I'm very excited. We're just going to jump right into it, right? We're going to pick up this video where we left off. This is from Project Finance, Options Trading for Beginners, the ultimate in-depth guide with over 17 million views. If you haven't caught up on these before, we are going through them about 15 minutes at a time, and I'm giving you my perspective, my feedback of real-world options trading since 2009. Based on the theory that Chris Butler is teaching here. I've had a chance to interview Chris Butler in the past, and nice guy. But you know, a lot of the things that people talk about on YouTube is theory, and I'm trying to give you my perspective on reality, right? So let's continue on with this video here. Let's not waste any more time.
Let's take a quick breather, take a glass of water, do whatever you need to do, and then let's get back to it. So now we are going to move on to the second option type. So thus far, everything we've talked about has been call options, and particularly buying call options and how that trade works. So now we are going to explore the second option type, which is called a put option. Now, if you started to understand how call options worked in the previous section.
Oh, let's teleport to the library real quick. Oh geez, this is like totally butcher my green screen. All right, so put options have a special place in my heart. Back when I was working in corporate finance, there was a conversation that was going on in the work area, and the director of the group was talking to another person, a colleague of mine, and I was in consulting. And what we would do is we would work with credit union CEOs to give them tools and strategies to decrease their risk and increase their profitability. Sounds very familiar to save time, make money, start winning with less risk, doesn't it? Yeah, I've been doing this for a minute, okay? But out in the Cube Zone one day, God, I don't remember what year this was, but there was a conversation going on about Deutsche Bank, and the director and this other person, her name was Amy. Amy and Mark. Mark was the director. And Amy was talking about how much she thinks Deutsche Bank stock is going to fall. And Mark's like, well, if you think it's going to fall so much, why don't you go buy puts on it? And like we didn't trade in that group or anything like that. So the word put just it's like pricked my ear, and I'm like, hang on. It's been a hot minute since I've heard about puts, right? So I got my undergrad in management. I got my MBA in finance. I traded in the student-led investment fund when I was in college, but that was the extent of all the put buying that I had even heard of. Was all the way back in college, years before that. And so I was like, what is puts? What is puts? And I was one of those nerds who kept all of his textbooks. So I reached over and I grabbed this particular textbook right here, Foundations of Financial Management. And I was like, okay, what are puts? I need to research this real quick. And I left 2 tabs from college. One of them is options and one of them is bonds, as you can see right there. So I flipped to the options page on page 571, and I had written myself a couple notes on here, highlighted a couple things. And basically it says a put option increases in value as the price of the stock goes down. That was the catalyst. That right there was the spark that lit my options trading flame. That exact moment. Because I was like, hang on a minute. I can make money as the stocks are going down? Huh. Because I would bet you more than 80% of people have no idea that you can actually make money as the price of the stock goes down. So this was a huge revelation to me. And I deep dove all the way down to the bottom of the oceans of options trading. And I mean, like legitimately, that was the spark right there that changed my entire life. So it's kind of cool, right? I have a soft spot for puts because of that. However, I've lost a ton of money on puts, right? I've made some money, but I think I've lost more money than made on puts on the whole. Reason being is that puts make money as the price of the stock goes down. What's the market done in the last, I don't know, any number of years? What's the market done? Right? What's the market done? Basically every year except 2022. Right? It's not that hard to figure out. What's the market done every year except 2022 when it went down? And so buying puts absolutely works, but you need to be doing it during a time when the market is going down and not trying to counter trend as the market's going up, because as the market's pushing up higher, a rising tide lifts all ships. So even if you found a stock that is absolutely crashing, if everything else around it is moving up, it's not going to be as forceful. You don't have the slingshot setup if everything else is moving up and your one stock is moving down. So yeah, just thought I'd share that story with you guys.
Section, then you're going to pick up put options just like that, because the concepts are all exactly the same, except everything is flipped on its head. So with put options, put option prices actually increase as the stock price is falling, and they actually decrease as the stock price is increasing. The reason that is that a put option gives the buyer the right to sell 100 shares of stock at the put option strike.
So let's conceptualize this real quick. When you buy the put option, you now have the ability to short sell the stock. Now, if you've never done this before, don't worry. Hopefully Chris Butler will explain it. But short sell is exactly the opposite of buying. Okay. It means to basically borrow the shares as the price goes down. And then once the price has stopped going down, you can sell them back, or you can buy to close them back, and you can be profitable. Now, that is a difficult concept to understand. So I try to break it down as to when you're buying an option, buying a call option, you want the price to go up. When you're buying a put option, you want the price to go down. Right? In a nutshell, that is the objective here. Now, as far as like buying a stock and wanting it to go up, short selling a stock, wanting it to go down, there's a lot of underlying things that go along with that. But at the end of the day, what you're trying to do is take advantage of the price movement one way or the other.
Strike price between now and expiration. So while call options allow you to buy 100 shares of stock at the call's strike price, put options allow you to sell 100 shares of stock at the put option's strike price. So because of that, put options actually increase in value as the share price is falling, because the ability to sell shares of stock at the put option's fixed strike price gets more and more advantageous as the share price is falling. And just like we did for the call options, we are going to look at numerous put option examples so that you can understand and that you can see how these trades perform and what you need to happen to make money when trading put options. So let's get started with.
Okay, a couple of questions from the chat. Brett said, will you show us the last time you shorted the market? For sure. Hang on. Just a moment here. The last time I bought puts was actually this year in 2025. I'll show you exactly what I bought when I bought it. It was, last time I bought puts was February 25th on IBN. I remember making the jokes about puts. IBN some puts here. And the receipts are on YouTube, so you can go back and you can look at it as well. February 25th was long puts on the 30 strike of IBN when it was trading at 28.20. So let me move a couple things around here for you real quick. So it was February 25th. Here. That was when I got the sell signal through Outlier. And I bought the 30 strike. So it was above that point, right? Because I go deep in the money. But the current price at that time was 28.20 when I got in. 28.18 is fine. Right. Now, I got out when the price was, I got out the date of the 27th. So I wasn't in it for very long, just for 2 days here. I got out because I had a heat map stall in Outlier, right? So I took a couple dollars out of it. It wasn't a huge move, right? It wasn't a huge move, but I was able to be profitable with this trade before it turned around. Now there's another one that I put on that was a loser. That was SCCO. Both of these are the only puts I bought since probably 2022. SCCO on March 3rd. Here, I bought on the bottom of this candle, I believe it was. I got in 86.80. 86.80, so it's a little bit higher. 86.80 is about right here. You can see it went down one day after that, but then it turned back around. And I got out on March 5th, 2 days later, small loss, right? So between IBN and SCCO, I was down a little bit. On the whole, on the balance, I was down a little bit between the two. Those are the only two puts I bought since 2022. All right. The market screams higher. Right? You don't have to be shorting all the time. No way. No way. So since Brett asked that question, I wanted to answer that. There was another question in the chat. I'm actually going to go to ChatGPT for this answer. Hold tight real quick. Reason being is because I don't want to get the answer wrong. There was another question. Thank you, Brett, for that question, by the way. Why are options, here we go. Why are options called calls and puts? What I remember is something like it's going to put the stock to you. That's what I remember it being. Call option, you can call the stock away. Put option, put the stock to someone else. Because they give the person who bought it the right to call the option, call the stock away. A call gives the buyer the right, but not the obligation, to buy a stock at a specific price. We talked about this the last couple of times, right? So if we go to an options chain, and let's say that I want to buy the 114 calls right here, while the price is at 122, I have the option to do that. It doesn't make sense to do that if I have to pay so much for the price of the option, but that is my right as the option owner to do that. You're essentially saying, I want to call the stock to me at this price. I want to call the stock at 114 to me when it's trading at 123. Okay. Put option, put the stock to someone else. A put gives the buyer the right to sell a stock at a specific price. And in this case, this is short selling a stock. You're saying, I want the right to put the stock on someone else at this price. Meaning that if I'm short selling this, somebody else is on the opposite end of it buying it from me, right? And so a market maker most likely is going to be the one transacting with you in that case. So there you go. A quick way to remember is a call means you're buying it. A put means you're selling it. You're putting it away. You want it to go down. A call means you're calling it in. You want it to go up. Yeah. And so in simplistic terms, like you want one to be going up and one to be going down. And right, it can get a lot more complicated than that, but you don't have to think about it that more complicated, right? Options are complicated on its own. So we want to simplify this as easy as we can. Ben actually got it. Yeah. Called away or put to you for sure. He must have written that for ChatGPT. The Hammer Donkey says, good morning. Luke says, Chris, is the liquidity for puts generally lower than calls? I noticed that I was looking at the SPX options chain yesterday. Let's go to the SPX options chain and let's take a look at it together here. SPX. And for those of you who don't know, SPX is when you're trading on the S&P 500. The SPY is an ETF of that. SPX is the actual market itself. So he's talking about puts. Let's go to, let's see. I generally like the 21 days to expiration, which would put us right, hang on. There's so many expirations on SPX. It's like almost every day. June 25th right here. That's 21 days from now. Open interest is really low on the puts. Really low on the puts right here. But if you look on the calls, I mean, it's not super high, but it is a little bit higher. Let's go to something like, let's go to the SPY and see if that's the same over there. So if we go to 23 days, that's the closest to 21. Even the SPY open interest is a lot lower here on the in the money puts, which is where I would trade, versus the in the money calls. Isn't that interesting? You know why I bet that's the case? Because the market's going up, right? If I were a betting man, I would say the reason being is that the market's going up. However, when that turns around, when the market starts moving down, I would bet that this lights up bigly. I would bet this lights up bigly. A lot of people use put options just as a hedge. Like let's say they're super long stock and they want to make sure that if the price of the stock goes down, that they'll still have some sort of recovery. And they're okay with the puts expiring for absolutely useless. But not me. All right, let's continue on with this.
With an example and look at an image that I recently captured in IWM which is the Russell 2000 ETF. In this image and in this moment, the first thing that I want you to notice is that the IWM share price is $130.71. Again, we are going to go to the June options, and this time the June options expire in 38 days. In this example, I've set up an order to purchase the June put option in IWM with a strike price of $130.
Okay. So talking about the expiration cycle, all options have an expiration. We know this. The June expiration at the time of this recording was 38 days away. And he's looking at the 130 put option. So this is an out of the money. It's really an at the money put option. At the money, out of the money, in the money. Let's define those terms real quick. In the money, when you're looking at calls, is the top left-hand quadrant. If you're looking at puts, it's the bottom right-hand quadrant. What makes it in the money, at the money, and out of the money? That's how much it is in past the strike price, right? So for example, if I owned the 127 call and the current share price is 130, I'm $3 in the money on my options, okay? The difference between 130 and 127. However, let's look on the put side. If I own the 135 puts, right, and it's now at $130, my 135 put is $5 in the money. The objective with all options is to get them in the money as deep as possible, right? Now, you can start on the right foot by buying one that's already in the money, or you can start on the back foot and try and get it in the money, right? Moving from 126 up to, $5 further up. It's a lot harder that way, significantly harder.
So the stock price is currently $130.71, and the put option trade that I am looking at is buying the put option with a strike price of $130 that expires in June, which is 38 days away. As we can see in the bottom middle of this image, the put option's price is $6.24. But as we've discussed, to get the actual value or the premium of this option, we have to take that price of $6.24 and multiply it by the option contract multiplier of 100 to get the options cost, value, or premium of $624.
The way that I look at this, and in my opinion, this is the simplest way to look at it. It's going to cost me $6.24 to control each share of stock. If the price of the stock is $130 and I'm spending $6.24, that's a tremendous deal, right? I mean, that is significantly less per share than to buy it itself outright. Now, keep in mind, at the money is basically a 50 delta, give or take a couple pennies here or there. It's basically a 50 delta. What that means is that if I buy the stock, the equivalent move is about 50 cents on each dollar the underlying stock moves. Meaning, even though I bought it for $6.24, it's not really a one-for-one translation, right? It's actually more like 2-for-1 in this case. So the stock price would have to move $2 or my option price to move $1 because it's roughly a 50 delta. So 50 cents for every $1 move in the stock. Deep Thought says, you mean to tell me the most open interest is where the best chance of making the money is? In the money calls when the market's going up? It's almost like you know what you're talking about. Yeah, dude, of course, right? You want to be going with the trend. And if the trend is moving up, by God, I want to be going with that trend. I don't want to be standing on the tracks in front of the trend train saying, no, stop right there, turn around. But so many people do that because they think they're the genius who's going to catch the top or catch the bottom, rather than catching the 80% in the middle, which is where the easy money's made. Yeah, Deep Thought sent me this coffee mug, by the way. Don't get monkey hammered. Hashtag sit in cash and don't F up. Thank you, my friend. You are awesome. Theo has a question. What about the call options? Although we talk for put options ending like January 2026, thinking of copying Pelosi on Tim. They are way too expensive now, but still, dude. If you want the price of the stock to go up, you buy the call option, right? It's simple as that. You could, and I will never, ever, ever recommend you sell a put option to get to that point. At some point later on, he's going to talk about selling options. You will never, from now until the history of time, hear from me saying to sell options, but you could. but don't do it. Don't do it.
And that's because, just like call options, a put option can sell 100 shares of stock at the put's strike price. So the put option contract multiplier is the same as calls, and to get the actual cost or the value or the premium of the option, whatever you want to call it, is the price, which in this case is $6.24, multiplied by the option contract multiplier of 100, which gives us an option cost or premium of $624. And we can
Okay, let's take a slight break, slight detour, because Dawn brought up something about SGOV. I only recently learned about SGOV. This cost me, I can't tell you how much, untold amount of money. SGOV. Let's get ChatGPT to explain SGOV real quick. What is SGOV? So SGOV is an ETF that allows you to basically own treasury bonds. Oh, wow, that's new. I've never seen a chart inside of ChatGPT. That's cool. Okay. It allows you to own very short-term treasury bonds. SGOV is an ETF designed to provide investors with exposure to U.S. Treasury securities that have remaining maturities of 3 months or less. Now, it allows you to make a yield of roughly 5.07%. That's annual. Okay. That's an annualized yield. Somewhere between 4.19 and 5.07, right? Because we're taking advantage of the U.S. Treasury bonds. Okay. Now, the yield curve is super elevated right now, right? If you look at the yield curve, hang on. You can tell I'm a finance bro. Yield curve today compared to 5 years ago. This should be interesting. So the yield curve today, let's see. This is 2019. Hold on. What do I mean by the yield curve? Here we go. So a yield curve normally looks something like this, where your shortest term bonds are paying the least amount of money. And then the longer out you go, the more they pay in interest, okay? What's happened is, and this is since 2022, what's happened is the front end of the curve, the short end of the curve has elevated tremendously. So now the whole interest rate curve is much flatter. You can see how much flatter it is here than it was right here. And that was in 2022. I wonder if this gives us like a more up-to-date, hello, thank you very much. Look at that. Isn't that interesting? That is one messed up looking yield curve right there, isn't it? You can make more money on 1 month treasuries, 2 month treasuries, 3 month treasuries, 4 month treasuries, and 6 month treasuries than you can on a 2 and a 3 year treasury, and a 5 year treasury, and a 7 year treasury. The reason being is that this is uncertain, right? There's a lot of uncertainty going on right now. Because of that, the premium is up in the front end. Everybody wants to be in the front end. Nobody wants to take that risk out on the back end, right? Does that make sense? Now, this goes up higher, as you would expect, but also look at the price difference here. We're talking 4.25 on the Fed funds rate, which is overnight. Let's use the 1 month rate here. Basically 4.3, okay? 4.3 for 1 month, or let's just call it 5. 4.3 for 1 month, or 5% for 30 years. Which one are you going for? I'm certainly going to go for the 4.3 in 1 month. Now, you're not going to make all 4.3. That's an annualized rate of return there. Or 5% for 30 years. Crazy, right? Crazy, right? So SGOV allows us to put our excess liquidity, meaning cash, into a product that pays us a yield. Now, how cool is that, right? I wish I had learned about this years ago. So as of yesterday, all of my excess funds, all of my excess liquidity goes into SGOV. Whenever I need to trade something, I will pull out the portion I need, if it's 10%, 50%, 80%, and put that into the trades that I'm making. Elsewise, it all stays in there, right? How cool is that? I am very, very stuck. I'm very, very excited. Now, Christopher talks about, looks like SGOV drops on the last day of the month. Confusing. Should you sell on the 29th and buy it the first? I'm really glad you brought this up. We've shifted gears a little bit off of options onto this SGOV. So SGOV does exactly that. Now, what's cool about this is that this is the first and this is the last day of each month. we can see the rotation. We can see the rotation right here, right? It drops by the amount of the dividend paid. That is your interest paid out. And that's exactly what happens on every stock that pays a dividend. Every single stock that pays a dividend out in the market, it drops by the amount of the dividend. So you're looking at this and you're like, well, this doesn't make sense. I'm just like cycling this every single time. But you get that dividend in the form of a distribution into your account. So let's say it went from 170 to 136. So that's 100.70 minus 100.36. So it's 34 cents. Let's say you had 1,000 shares. Okay, that's $340 that they just took and put it into your account. And you now have that cash in your account, which in theory will allow you to go and reinvest it into this. Okay, so you're actually getting paid monthly. Now, here's a little hack that Dave taught me. You can actually get paid sooner by just taking your money out here the last day of the month and then buying it back in here. Now you're going to have transaction costs, but on this, they're so unbelievably low. Like I was calculating them for my account. It's like $1.50. And I'm like, okay, I can live with that. And I have a big account. Okay. And I'm looking at this and I'm like, okay, so you buy it here, you sell it here, you repeat the process, rinse and repeat over and over and over. And then you're still capturing that entirety of that move. But rather than waiting for 3, 5, 7 days for it to pay into your account, you sell it here. You've captured the entirety of that move in your account right away. Now, what's also cool about that is let's say that you buy it here and you need your liquidity here halfway through the month. You don't have to wait for the next month to get paid that distribution on your interest. You actually get paid between the growth from here to here, right? The reason it's going up each day is because it's earning that interest day after day. So you can basically get paid every day you own the stock and take it out right away. Super easy. Now, this is great for people like me who don't have an account that automatically invests your excess liquidity. I wish that I did, but I don't. Right now, this is an extra step I have to make. However, it's totally worth it. Totally worth it. Like Paul is saying here, Fidelity pays you interest on your account, so you don't have to do anything. But if you're in an account that doesn't do that, this is a really cool vehicle, right? Really cool vehicle. Oh, Deep Thought says, just for fun, click the adjust button on your chart. Okay. And I'm gonna click it in 3, 2, 1. Oh, look at that. Very cool. So this is what it looks like. Dude, Deep Thought, thank you for that. Now, this is what it looks like, which you can see is basically a straight line. This is what it looks like when it accounts for those dividends. When it accounts, instead of it actually readjusting the price like it does, right? This is what it looks like if you just held and got the dividends every time. Isn't that cool? Isn't that cool? Arnon, you're very, very welcome. Yeah, neat, right? Super neat, super neat. So turn that off. This is what the actual price is doing. But if you turn this on, this is what it actually looks like in your account. This is what it looks like in your account because the price is growing, you get the dividend. The price is growing, you get the dividend. The price is growing, you get the dividend. And this is what happens when it pays out the dividend. Super cool, right? Super cool. Oh yeah, and there are some advantages to this, right? They're exempt from most state taxes as well. Yeah. Go figure all that stuff out for yourself. I'm not going to give you any tax advice, but yeah, it does have some benefits to that too. Okay, so the real answer and the reason I want to bring that up is it's sit in cash and don't F up, right? Sit in cash and don't F up, but you're actually earning some on cash. This is where I'm putting my cash now. And I'm not changing sit in cash and don't F up. I'm just setting my cash right here because I'm going to get paid just like a savings account. Isn't that cool? Isn't that cool? Now that's super determined, or that's an ad. It's super it's obviously very correlated to bond yields. So if bond yields drop, the interest you earn will drop. Right? If bond yields go higher, you'll earn more. So pretty neat. I'm excited to start having that as part of my portfolio, and I'm excited to have more cash in my account every single day. How cool is that too? Every single day you will have more cash in your account. Not too shabby. Not too shabby while you're waiting for the next trade to come along.
Verify that this option is worth $624 by looking at the maximum loss on this trading platform. The maximum loss says $624, and when you buy options, the most you can lose is the premium that you pay for the option as we briefly discussed in the previous call option section. Now you might be wondering, the stock price is currently at $130.72, but the option strike price for the put option that we are looking at is $130. And since a put option gives the buyer of that option the right to sell 100 shares of stock at the put option strike price between now and expiration, why is this put option worth $624 when there's really no value in owning this put option? I could just sell shares of stock right now for $130.72, and I would sell it at a higher price than I could sell these shares for by using my put option. So why is this put option valuable when the stock price is above the put option's strike price? We're not going to talk about it right now, but this is just something I want to put on your radar, because in the next section, we are going to dive in exactly why this is. But for right now, I want to focus on how put options work and how their prices change relative to the stock price. But I want you to just notice that the strike price of this put option is $130, but the stock price is currently above that strike price, but this option still has pretty significant value. So I want you to just be aware of that. We're not going to discuss why that is right this second. But if you were wondering, why is this put option valuable when the stock price is above its strike price, I want you to know that I hear your questions and we are going to get to it in the next section. But for now, I want to focus on teaching you how put option prices change relative to the stock price and why that happens. So let's go ahead and see what happens with this IWM put option. So a few days later, as luck would have it, I took another screenshot of IWM, and this time IWM had fallen significantly since the first image that I captured, where IWM was over $130 per share. In this image, IWM is currently at a share price of $122.
Okay, cool. So we talked earlier about Delta, right? So the price of it went from 130-ish to 122-ish. So the price went down by $8. Now, I assume that was the, hang on, let's go back real quick. I want to see the option he was looking at before was the 130s, and it was about $6. And now he's looking at the 130s again, and it's about $11. So the price of the stock went down $8. The price of the option went up about $5, right? That's the delta, right? Now, this is the trade-off. When you buy something that's at the money, you're not going to take full advantage of that, right? So this one here, it increased at the delta from around 50 to 60. And I can't tell where the delta is right now, but probably closer to 70. How great would it be to just start at that point, right? I like to start at the 80 delta and then let it work up. This is a huge game changer for you. But let's continue on here.
For $11.30, meaning that the option has a value or premium of $1,130. The put option's value surged because the share price of IWM fell. And
here we go. This is what I wanted to see. Now, what was the actual delta between these 2 points? We can calculate the math of this, okay? I love to calculate real deltas. So the price of the option went from 6.24 up to 1130, meaning it went up by this minus this, okay, $5.06. The stock went from 130.71 to 122.72. Okay, so that is this minus this, okay, $7.99. So that's the difference here. Now, the price of the option divided by the price of the stock means the actual delta on that was 63 cents. How cool. You can calculate this yourself. The actual delta, it started around 50 and then it went up because it's going deeper into the money. The actual delta ended up being 63. Pretty neat, right? So for every dollar that IWM went down, the price of the option went up by 63 cents. Pretty neat.
Because put options have the ability to sell 100 shares of stock at the put's strike price, and since the put strike price was 130, since we saw IWM go from 130.71 all the way to 122.72, the put option is now in the money, so to speak, meaning that the stock price is significantly below the put option strike price of
Well, it's not so to speak. It's $8 in the money. It's not so to speak. It is literally $8 in the money.
$130. And now that this option can actually provide a benefit to the buyer of that option, meaning that if I bought this option a couple days ago for $624 in premium, and now the share price is 122.72, which is way below the strike price of 130, I could use my put option to sell shares of stock at 130, which is immensely valuable because the stock price is currently well below that at 122.72. But remember earlier, I said that you never have to exercise an option to realize the profits. And we can see that is the case because the option in this example with the lower stock price is $11.30.
To that point, we mentioned this probably every video so far. You never have to exercise the option. No way. Right? In that example we did right here, you don't have to own the underlying stocks. You can just trade the option, right? You're just trading coupons basically at the end of the day. I have a coupon that allows me to short at 130. That coupon got more valuable. Okay, that allowed me to sell shares short at 130. That coupon got more valuable because at the time it was $122. Today it's at $130, which means that coupon, it gives me the right to buy it or to short sell it at 130, just became way more valuable. But I don't actually have to do anything at all with the underlying shares.
So if I had purchased this put option on day one and I paid $624 for this option, and I held it until this image where it was worth $1,130, if I sold this put option, I would secure a profit of $506 on a $624 initial trade cost. And if I secure a profit of $506 on an initial cost of $624, my return on that trade is 81%.
This is why we trade options, right? The price of the stock went down by $8. The price of the option, let's do the math, equals the change divided by the old price, 82% gain. 80 or 81.08. Let's just do this here. 81% gain. How cool is that? The price of the stock went down by $7.99 divided by old price. It went down by 6%. Yet my option went up 81%. If this doesn't convince you that you've got to start trading options, I don't know what else does. The price of the stock went down 6. We wanted the price 6%. We wanted the price of the stock to go down. It did that. Our return was 81%. Meaning we had this divided by this. No, that wasn't right. Equals 81 divided by 6. 13 times higher. 13 times higher return by buying the option. The underlying stock did what the underlying stock was going to do, and we got paid 13 times more for doing that. Isn't that cool?
But if we look at the percentage change in the shares of IWM, initially they were at $130.71, but then they fell to $122.72, which is a 6.1% decline in the share price of IWM. But the 130 put option that we were looking at experienced a price increase of 81%. And again, that means that when you buy put options, you have leverage. Now, just like we did with the call option section, I know you're already thinking, what is the catch? And there is a catch, just like with buying call options. When you buy put options, if you buy put options and the stock price does not decrease, you will lose money. So in this example where the IWM share price was $130.71, if I bought that 130 put option for $624 in premium, and at the time of June expiration, IWM was above $130 per share because I don't actually need to use my put option to sell shares of stock at the strike price of 130, because if the share price is higher than the strike price, I can just sell shares of stock in the open market, and there is really no value in owning my call option. So just like with call options, if you buy a call option and the stock price doesn't increase or decreases, you will lose money. And with put options, if you buy a put option and the stock price does not fall or the stock price increases, you will lose money. So we'll look at an example of that right now. And for this example, we're going to look at a put option trade in NVIDIA. And obviously this trade is going to lose money because who is buying puts in NVIDIA? Who is betting against NVIDIA? Come on, man. On May 1st.
Okay, to that point, what he's saying right there is don't be buying puts. Don't be wanting the price of the stock to come down when the price of the stock is screaming higher. Now, this was released, let's give some perspective, May 25th of 2020. And what's cool about this is that what he's speaking of, all the options education here, is timeless. This will last forever. And that's why this video is doing as well as it is 5 years later, 17 million views. That's awesome. So again, that was May 25th, 2020. So if we look at the charts here, let's put May 25th, 2020 on the board. May 22nd, 2020 was a Friday. You must remember recording on a Saturday, or it uploaded on a Saturday. So we'll go with that Friday right there. Okay. Oh, and it's splitted. It's split. It has been split multiple times, because now this is around $9 a share. Yeah, this has been split several times. It's funny. What price is this showing?
First, NVIDIA's share price closed at $283 in the middle of a pretty vicious sell-off. So let's say a trader thought that the downside would continue in NVIDIA, huge mistake, and they went and bought the 280 put option in the May expiration cycle with NVIDIA shares at 283. On May 1st, the May 280 put option, meaning the put option in the May expiration with a strike price of $280, was trading for $11, meaning that I would have to pay $1,100 in premium to buy one of these put options at the strike price of $280 and expiring in May.
For those of you who don't know, the right-hand chart right here is the price of the option, right? This is the price of the option. This is the price of the stock. As you can see, as the price of the stock is going up, the price of the option, a put option, is going down in value. Remember, puts go up in value as the price of the stock goes down. Puts go down in value as the price of the stock goes up. They're inverse to the price of the stock.
Which had about 2 weeks to expiration at the time of entering this trade. So let's say a trader buys this 280 put option, paying $1,100 in premium for the put option that expires in 2 weeks in the May expiration and has a strike price of 280. Unfortunately, that trader would have lost everything that they put into that trade, because immediately after that sell-off, after May 1st, the stock price did end up surging higher, and therefore the put options price collapsed. And in the most recent date on this chart, we can see that NVIDIA's stock price was at around $321, over $40 higher than the put option strike price of $280. And on the very right-hand side, or the last bar seen in this option chart, the option only had 1 day left until expiration. And with the stock price over $40 above the put option strike price, and with only 1 day left until expiration, the option is basically going to expire worthless, because the stock price needs to fall over $40 for this put option to gain actual value or benefit by the time it expires in 1 day.
I wanna just add a little bit of that, because most people, and of course I'm trying to teach as we go, most people don't understand that when you say it expires worthless, meaning I had a quarter over here the other day. Where did that go? Here it is. The quarter that I hold in my hand, this quarter, with a date of 1990. Can you believe that? Not as old as me, but close. This quarter is worth more than that option you paid $1,100 for. That is why options trading can be exceptionally dangerous. because you paid $1,100 holding it to expiration, watching go out of the money, it is worth nothing, not even this quarter. So if you understand what you're doing, options are amazing. If you don't understand what you're doing, fastest way to blow up your account. And so I'm trying to help you understand what you're doing.
And because of that, and since there's such a low probability of that happening, we can see that this put options value 1 day before expiration and with a strike price $40 below the stock price, that put option was trading for 1 or 2 pennies, meaning that it was essentially worthless. So if a trader bought this put option for $1,100 and they held it until the expiration when Nvidia was $320 or higher, they would have lost the entire $1,100 premium that they paid for this put option because the put option would have expired worthless. Now, if the stock price is above the put option strike price at expiration, the put option will expire worthless, meaning that if you have a position in that option, it will disappear from your trading account after the expiration date, and you will be left with whatever profit or loss you had on that position. And in the case of buying a put option, you will have a loss, since if in this case you bought the put option for $1,100 and it expired worthless, you would have a loss of $1,100 on that trade. So while you can make significant returns on your investment or trade cost when you are buying put options, obviously you can lose 100% of what you pay for those put options, which means that while you can make 100% returns on the trade cost, you can also lose 100% when you are buying options. But the big benefit of buying put options is that compared to shorting 100 shares of stock, buying put options is far safer by a long shot.
Significantly, like legit. Let's look at let's do long put option. What I want to show you here is if the price of the stock goes down, right? Imagine X is the current price. If the price of the stock goes down, you have unlimited profitability. If the price of the stock goes up, you're limited to what you paid for it. So in this case, as Nvidia, going back to that example, let's go back to that example here. Yeah, this is actually going to be a great example. You bought that option for $1,100, right? So $11 per option contract. The price of Nvidia went up $40. If you had shorted shares, you would be out $40 per share versus just the $11 per share that you did with this option contract. So by buying a put, you actually capped your risk to $11 total per share. Whereas Nvidia ran up $40 a share. So even though you were wrong on the trade, you could have been a lot worse off had you just shorted it outright. Corey, yeah, exactly. It's all about risk management. All about risk management. All right, let's get him to wrap up this section here and we'll call it a day. I hope you guys are learning something. All right, if you're learning something, do me a favor in the chat, type learn. I don't care how you spell it. You can spell it like LURN. You can type it like LEARN. I don't care. But just let me know if you're learning something as we go. I like being able to do this. I feel like it's helpful to go along with this video to give my real world commentary to go with it.
When you're shorting stocks, you have theoretically unlimited loss potential. So in that case, if you were comparing shorting 100 shares of stock to buying a put option, you would have much less risk buying a put option compared to shorting 100 shares of stock. So in this Nvidia example, if I shorted 100 shares of stock at $280 per share and the share price went to $320, I would have a loss of $4,000. So a $40 loss on 100 shares.
That's what I was just saying. That's what I was just saying. If you were shorting it outright, you lose all $40 per share, which if you did 100 shares, that's $4,000. Yeah, look at that.
Would give me a loss of $4,000. But in this example, we saw that the put option purchase only lost $1,100. So when you compare shorting stock to buying a put is, in my opinion, a much better way to do things. If you're unfamiliar with what shorting stock is and how it works, I will leave a link down in the description below so that you can get my video explanation and demonstration of shorting a stock. By the way, you can download a full PDF of.
By the way, there was a question in the chat. Since he's changing topics here, I'll do the same. There's a question in the chat. Let me roll up to this real quick. Eric had a great question. Eric's question was, if a person was interested in trading, how much per day would Outlier cost for all of the fantastic data that provides? Well, Eric, thank you so much for that layup right there. You can grab Outlier, but listen, don't go get Outlier if you want to trade the hard way. All right. If you want to like really struggle in the market, continue doing what you're doing. But if you're ready to save time, make money, and start winning with less risk, I would suggest heading over to outlier.com because you can get the annual pass for literally 82 cents a day, which is 64% off the regular monthly price. And if you're on the monthly plan, you can upgrade to the annual pass in one click and save that 64%. So listen, I'm really enjoying doing this. We will continue to do this every Wednesday morning. And if you're ready to save time, make money, and start winning with less risk, there's going to be 2 videos pop up here, at least on the replay, not on the live stream. You guys know that. On the replay, and that'll help you save time, make money, and start winning with less risk. We'll talk soon.